So let's talk about risk management, which is like literally probably the most important thing. So you could have a strategy, you could have a system in place, but if you don't know how to manage your risk, or if you don't have any kind of risk management plan in place, um, essentially you're going to end up losing all your money no matter what. So let's talk about money management 101. So the first thing is, like I just said, you got to have a system in place. The system needs to be able to control your risk and your money. You have to pre-plan your trades, like what we literally have just been doing, right? You have to pre-plan the trades. You can't just open up the charts and be like, yeah, this is here's a trade and boom, and pop in a trade without risking putting in your risk parameters to what the trade is without confirming your trade setups or having multiple forms of confirmations or anything like that. That's what like people who are trying to double their account in a day or whatnots do. You don't do that because you're not trying to. You're trying to grow this out over an extended period of time of years, not week or month. The next thing is you need to expect losing streaks. Losing streaks are going to happen. You can't avoid them. They're going to happen. They usually happen right after a winning streak because you feel invincible. And you feel like you're God and you could like trade with your eyes closed. So the losing streaks are going to come. The question becomes, how do you stop them? And does your risk management plan allow you to account for them? So you got to learn basically how to manage your losing streaks. Okay, so I'm going to show you how to do all that stuff. So when you talk about money management plan, it has to have a way for you to deal with losing streaks. It has to allow you to flatline the losses. So you have to be able to kill the losses. Plan has to allow you to have a step equity growth, right? So you ever looked at somebody's or even your own, um, like let's say my FX book, and you notice how you start off at 0 and then like you go down 10, up, down, 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 and then up, 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 like an equity curve like that. The equity curve that you want to have is basically almost like a trending cycle, like up, a retracement. The retracement is basically your losses. Another up, down, up, down, up, down. A smooth, up and down, but going up in an up motion. You don't want to have an equity curve of going, starting at 0, going down 10%, then coming back up 5, and then going back down 20, then going up 15, back down 10. Like you don't want to have that. Now, good money management plan allows you to move or reduce your risk based on your wins and losses. So you should be able to move or reduce your risk based on how you're doing within your wins and your losses. So what does that look like? What does a risk management plan look like essentially? Let me show you what that looks like. So you guys should see a white screen now, is that correct? Okay. All right, so Here's the risk management plan that you should be using. The first thing is determining how much money do you have to trade, right? So how much money do you have to trade? Give me an example of an amount that you would have to trade, so I can show you an example of a risk management plan to go with that. So 1,000 USD, so $1,000, so 1K. All right. So you have 1K in your account. What do you think should be your lot size if you have 1K in your account? Point one. Okay. Anybody else? Where does everybody else think? What should your lot size be if you have $1,000 to trade? Sharon, you're saying one like a standard lot. Is that what you're saying? Gotcha. Point one. Okay. Yeah. So, how many pips in general is a 0.10? What's the dollar amount per pip? So if you're going to be trading a 0.10 lot, how much money is that per pip? Right, $1, right? Yes, $1. Okay. So if you're trying to trade $1,000 account and your goal is to make 30 pips, that basically means that you're making $30 per trade, right? Everybody follow me so far? So every trade that you take is basically worth $30. Every loss that you take is worth $15. That makes sense so far? So if you're risking $15 per trade because you're taking a standard lot size, what's the percentage of that of your account that you're risking per trade? Right, 1.5. Right, so the percentage that you're risking is 1.5%. Okay? So kind of basically like super low risk, right? Pretty low. Nothing too extravagant or crazy, right? So how can you make this work to where you can have a plan in place to where essentially you're trading and having to manage your risk along the way? Here's how I would do it. If I have $1,000 account and the lot size that I'm trading is 0.10, here's what I'm thinking in my head. The actual lot size of 1.0 of 0.10 is my max lot size. So 0.10 is my max. That's the max lot size that I can use on one trade. But what if you wanted to trade 3 pairs? What if there's setups? What if there's really good setups on like 3 pairs? What do you do? Do you trade 0.10, 0.10, 0.10 on each pair? Right? You definitely don't do that, right? Because then you're risking 1.5, 1.5, 1.5, right? Now you're up to like 4 something percent of your account, right? So you're not doing that. So here's what I would do. I would start out with trading like this. So my first trade that I would take is actually at a point 0.06 is my first trade. And this is what the premise of you taking one trade at a time. Okay? If you're taking multiple trades, then you split this in half. But let's just say we're taking one trade at a time. So if you take a 0.06 trade, the first trade that you take, and let's say you win that one, right? The next trade that I take, I'm doing a 0.7. If I win that trade, cool. I go to a 0.8 the next trade. If I win that, the next trade I take is a 0.9. If I win that, then the next trade is a point W, or a 0.10. So I've taken 1, 2, 3, 4, 5 trades. Let's say that I've won all the trades. Okay. What usually happens after you win 5 trades? Think about what your emotional state is after you win 5 straight trades. What are you thinking about? More, right? Big lot size, right? How high is your confidence? To the moon, right? Yeah, exactly. So, what typically happens to the retail trader when they get 5 wins in a row? They're like, man, this is way too easy, right? Why am I trading a 0.10? Why don't I trade a standard lot instead? Right? And so what's probably going to happen when he trades this one lot size? A loss is coming, right? So all the profits that you did great on all your 5 trades here are gone, and you jacked it up on one trade because you over leveraged your account, right? So to account for this, this is what I do. So if I get 5 wins in a row, okay, my next trade after this, I'm actually going back to 0.06. Because if I take a loss on the next trade, I'd rather be at a 0.06 than at my max lot size. Does that make sense to you guys? So that's what I'm doing on my next trade. If I win this one, awesome. I do it all over again. 07, win, 08, win. Keep doing the same thing over and over and over and over again, right? So I keep doing this. As long as I'm winning, I keep doing. I go one up until I get to the max. Once I get to my max, I go back and start over again. Because I'm expecting a loss. At some point, it's going to happen. I'd rather it be at a 06, 07, 08, 09, right? I don't want it to be at a 0.10. Okay? So now, let's say I had this, I did it, I won all 5, I go back to 0.06 right here, right? And let's say that on this 0.06, let's just say I actually lose that one. My next trade that I take is still at a 0.06. If I win this one, cool. I go back and I go up to a 0.07. If I lose this one, I'm going back my next trade to a 0.06. So let's say I win this one, and then I go up to a 0.07. I win this one, I go back to a 0.08, and let's say this one I lose. Cool. I go back, my next trade is a 0.06 again. So every time that I lose a trade, I go back to my smallest lot size. Is everybody following me? Okay. So this allows me to automatically account for my losses. I'm already expecting it, right? So if I take a loss and I go back to 0.06, and then the next trade I go 0.07, I take a loss. I'm sorry, let me rephrase that. If I take a loss at 0.06, my next trade is again a 0.06. If I take another loss, my next trade is a 0.06. If I take another loss, my point is a 0.06. So if I'm losing, I'm not going anywhere up in my lot size. I'm staying the same. Right? But now, what is the problem that I encounter here? What's my biggest problem now? What am I in right now? Losing streak, right. So I'm in the middle of a losing streak. What do I do? I stop trading. I stop trading. You stop trading. If you get to 4 losses in a row, you stop trading. And I mean stop trading for like that day. Or the week or whatever, depending on how these losses come. If you've taken, if you're taking a trade, let's say 1 trade a day, and you've lost 4 trades in a row, stop trading for the week. Or cut the week short and call it a day. Okay. So if you've taken 4 trades in a day and you've lost 4 in a day, just stop trading for that day. if you've taken, 4 losses in a week in a row like this, stop trading for that week. There's no point in trying to keep trading, because after 4 losses, your mindset is all about trying to get the money back, and it's no longer about trying to find the right setup. Your mindset is about revenge trading to get back your money that you lost. Okay? So what do you do after that week or the day is over? How do you get back? Yeah, it happens. That's why I'm saying it. Word is because that's literally what happens. You start losing, and it seems for the life of you can't get not even one damn pip. Not even if they're giving them away, you can't catch them. And so you end up making just really stupid mistakes for no reason. So just stop trading. Cut the losses already. You know? It's like you're literally like bleeding out money. So cut it. Just remember that you're not here for a trading of a week or a month or whatever. You're trying to do this for years to come. You can't sustain the kind of losing that that you're doing. So just cut it. So what you have to do now is, after you stop trading, you got to have a plan to how do you get back on the winning side of a trade, right? How do you find a winning trade? So what you do is you go ahead and you have what's called a signature trade. I can't spell for the life of me, goddamn. So you have a signature trade. What the hell is a signature trade? You may ask. A signature trade is a trade setup that will get you a win. Think of different trade setups as different, playing cards. You want to play your ace. So if you're really good at type 1 setups, or if you're really good at continuation trades, or if you're really good at type 3 setups, whatever that setup is, that's the one that you're going to use. So essentially, you're not going to take a trade until you get that specific trade to show up on the charts. Does everybody follow me? So whatever that trade setup is, whatever it's, continuation trade, reversal, type 1, 2, 3, 4, whatever. Whatever your best trade setup is that you know well, that has all your confirmations, all that stuff. That's the next trade that you're taking, and you're not taking any other trades besides that one. And so once you do it, obviously then the cycle starts over again, right? You still do a point W, and then you could start going again, essentially. Now, what if you run into a situation to where your balance, let's say your balance of 1K that you initially started with drops below 1K. So if your balance is ever below the initial starting point that you had, you're doing nothing else but trading 0.06s, 0.06s until you get back up to your original balance. Does that make sense to you guys? Now, if your balance gets to be some ridiculous amount, let's say, I don't know, what do you call it? Let me do a calculation real quick. What's the percentage? It's 1,000. No, it's yeah. If your balance gets to be 20% or less, so in this case of $1,000, if it's like, let's say $800, so say your balance drops to $800, you cannot trade a 0.06 as your minimum stop loss. You have to make the adjustments, because at $800 your max lot size should be a point what? Right, a 0.08. So then just do the math. If your max lot size is a 0.08 at that point, right, just go backwards. 0.07, 06, 05, 04. So you're trading at a 0.04. And you're still at a 0.04 until you get back up to 1K. When you get up to 1K, you can go back to your 0.06. Does that make sense? So if your account balance ever drops below 20%, so in this case from 1K to 800, you need to adjust your lot size correctly. So you can literally account for the fact that you lost to 20% of your account. Because if you don't adjust your lot size at that point, you're basically now trading an $800 account close to your maximum lot size. And so if you take any losses, this is going to drain a lot faster. This is why if you have 4 losses in a row or more, just stop trading. Go back to the minimum lot size and then go ahead and trade the signature trade, whatever that may be. You're not trading anything else but that signature trade first. So, does all of this make sense to you guys? Do you understand what we're doing here with the risk management? Yeah. What questions do you have about this? Ah, yes. Is there a point when you raise your lot sizes? Yes, there is a point where you can raise your lot sizes. But in order to raise your lot size, what do you need to have? Do you, one second, let me get this. So observer, let's see your signature trade. So if you're talking about do I raise my lot size just to trade the signature trade? No. If you want to trade, like, let's say if you want to trade more than this, you need more of that. Do you get what I'm saying? So if you want to trade more than this as your max, you need more of money, more money, right? So let's just say, let's erase all this stuff. And let's say that you started with 1K, right? You trade your point oh 0.01 or your point 0.10 lot, and let's say you do this plan and you grow it to 2K. Once you get to 2K, now you can up your max to this as your max. So every $1,000 you go up, you raise it basically. So 3K would be 0.30, and it's the same thing, right? If you have a 3K in your account and your max is 3.0, then you're just going back down 5. Do you get what I'm saying? So you're doing what point what 26, 27, 28, 29, 30. For the compound effect, if you're trying to really grow an account yourself, like from scratch, right? You have to allow the compound effect to take place. The compound effect on a trading account really doesn't even get started until you get to 10K. That's when it really starts. Are you asking me if I trade two accounts or can you trade two accounts? Yeah, I mean, you could trade as many accounts as you want. I mean, it just depends. Are you trading two separate accounts because of what? You're wanting to do like two different strategies, or you know what I mean? or you have one account that has more money than the other one, you know? So I mean, regardless if you have two different accounts or not, I mean, you have to trade them according to what, what the balance is on the accounts. But if you're trying to really grow yourself, your own account, you have to compound, right? But the compound effect, really, it's not going to start growing until you get to 10K. Because at that point, now you're trading a standard lot size. And so at that point now it's $300 per trade. So if you really think about, what in general, how many people in, if you take a poll of 100 people, you're like, hey, every month, about how much money would you need a month to kind of survive, and just live a normal good life? What would you think that number is? Take a guess. To live it, I'm not talking about like living like an extravagant lifestyle. I'm just talking about living just a good normal life, having your bills paid, having all of your bills paid, being able to support you, your family, or whatever. Everybody's number is different, right? We get that. But like in general, if you ask somebody, hey, if you poll 100 or 1,000 people or whatever, I think the average is going to range somewhere around 5 to 6K or something like that. Depending, of course, on where you live. If you live in New York, you fucking need some crazy amount of money. Same thing if you live in California. California and New York are like the two anomalies because they're so expensive to live. But the majority of the people, you'd ask them, hey, 20, yeah, it's something ridiculous. Like, I would never move there. But let's just say if most people can get by with 5K a month, what does that translate to into actual trades, right? So if you're making, let's say, 300 per trade, that's about 16 trades or so a month. So 16 trades per month, what does that come out to a week? It's like 4 trades a week. So 4 trades a week, $300 a trade. That's $1,200 a week. Times four, it comes out to like 4,800 or so. So if you just get to 10K, this is where your account can really compound or starts to compound. This is why it's so important to still have a job. Because once you get it to 10K, now you're good. Now you can really start to see the effect on your trade or on your trading account. So once you, Sharon, so you asked, once you make like 2,000, should you withdraw your initial deposit? I mean, that's kind of up to you if you want to do that. So what you should keep in your account after withdrawal? Sam, what are you asking? Like, what should you keep after the account of what? Withdrawals. What you withdraw from your own account is, it's whatever you need, obviously. But I mean, the way that I would do it is I didn't touch any of my money that I traded for a while. I think you should keep more than 10K in your account. You have to remember everything that you withdraw, like you're paying capital gains on that. So remember that. Awanda. I have accounts with Awanda, IG, and FX Choice. So yeah, that's why I keep saying, like, you need a job, right? You need to keep your job. Because if you want to live off the profits of your trading, you need to build your account first. You can't quit your job if you just have 10K in your trading account. You know? What I'm saying is once you get to 10K, you'll see your account grow a hell of a lot faster. Nowadays, though, with the added, the addition of like all these prop firms that'll give you the money to trade, that's not no longer like a real problem. Now it's just talking about, do you know how to trade? The money part is no longer an issue. You not having 10K to trade, you not having $1,000 to trade now, that's not no longer a problem anymore, because you can just trade with a prop firm and they'll give you 100K. You just need to know how to trade. So now the opportunity of you actually making 5, 6, 7K are way more realistic. Because if you know how to trade and you have $100,000 account, I mean, just do the math. What's your lot size? What's your lot size on a 100K account? It's not 100 lots, Sam. It's 10 lots. You don't want to trade 100 lots. Trust me. You don't want to trade 100 lots. So on a 100K account, what is, and you're trading a 10 lots per trade, what's every trade worth? If a standard lot is worth $300, what's a 10 standard lots worth? Right, 3,000. So every trade is now a 3K trade. I mean, I'm not no mathematician or something, but if you take 16 trades at 3K per trade, that's a pretty big chunk of change. Yeah, 48K a month. Can you live off of that? Can you live off of that a month? You see what I mean? So, like, there's no, when you have an account like that, realistically, there's no reason for you to even trade a 10 lot sizes. You know what I mean? There's no reason to even stress about trading the max lot size. You could trade five lots. If you average 16, I mean, you're still making like 24K a month. Like, what are we talking about? You know? So, everything opens up, I'm telling you, once you have the money in the account. The possibilities are endless. I wish I had the opportunity to do prop firms whenever I was trading. And I probably did, I just wasn't aware of it. But now there's really the excuse that we had for so long is that we never had the money. Oh my God, we don't have 10, 20 grand to have in a trading account, because we're just normal people, right? But now we do have the ability to do that. We just need to know how to do the skill, you know? So questions on the risk management. Okay, so we're good on the risk management then. All right. So let's talk about trading psychology. You guys can see my trading psychology screen, right? Okay. So probably one of the hardest things that you can do in trading is trading psychology. And I think that when it comes to trading in general, there's like literally three core things that you need to be successful. So the first thing is you need a back-tested trading strategy, right? A strategy that that is literally back-tested, so you know what it's outputting for you, right? So you're not going out blind trying to trade something that you don't even know if it freaking works. You know what I mean? Like when you guys watch YouTube videos and stuff, and of other YouTubers that are out sharing their ideas, their strategies, their knowledge that they know. Do you guys ever watch those videos and then actually go and back test to see if what they're telling you actually works? How many of you actually done that? Not really. Okay. Who else? No. Do you just take what they're saying as to be true? Okay. Gotcha. Yeah, so I think, back testing has to be like, it's got to be in you, man. You got to want to back test, because you're never going to get to where you want to get to if you don't back test. It's like, if you want to be a doctor, like, you have to practice doing, surgeries and stuff, or doing, procedures and stuff. How many of you guys watch, like, what was that show? Grey's Anatomy. Did anybody ever watch Grey's Anatomy? Yes. Yeah. So, do you know how, like, when they go to the labs and they have all these, uh, makeups, suture kits, and you know, different stuff where they practice on and stuff? Yeah, they sit and observe the surgeries. Yep. And then also they go into the labs and they practice themselves. You know what I mean? So it's the same concept. The back testing part is literally that. It's doing that essentially. You know, that's what the back testing is in trading. So without doing any of that stuff, like, how far do you actually think you're gonna get? You know, or how much longer is it going to take you? Essentially, how much longer are you delaying the process? You know, so you definitely need to have a strategy that's been back tested so you know exactly what it's outputting for you. There's no reason for you to trade your real money if your strategy is like a 50-50 strategy, or if your strategy is a 40% winning rate or something like that. If you knew, just ask yourself, if you knew that the strategy that you're trading only produced 50% win rate, would you still trade it? You wouldn't trade it. So it's like, if you wouldn't trade it, why are you trading it? You know, because you don't know exactly what it produces, right? So like, I know what this strategy produces because I've back tested it, right? Since 2018, I've taken, what is it, like 1,200 trades. Let me give you an exact number real quick. So, come on. Yeah, trades. So, yeah, 1,376 trades. since what, 2018, right? So 1,300 and yeah, 1,376 total trades. I've won 1,056 out of 1,376. So 77% win rate and losing 23%. Right. So that's how I know it works, right? So you need a back-tested strategy. The next thing is literally what we just went over, is risk management. You need a risk management plan that can control your losses, right? I just showed you how to do it. And then the trading psychology mindset is the third thing that you need. So if you don't have these three things in place, you won't get to where you want to get to. So let's talk about just psychology in general. When you think about trading psychology, what's the biggest thing that comes to your mind of the problem with trading psychology, in the sense of, what most traders deal with? Right. FOMO. Yep. Yep. I think the biggest thing that really comes out of it, out of trading psychology, is just in general fear, right? And there's really two fears that come out of the trading psychology aspect for me. The first one is essentially fear of missing out, right? Fear of missing out on a trade. Like Ward, like what you just said, literally FOMO, right? Fear of missing out. So fear of missing out on a trade. And the second one is the fear of losing. If you can fix these two problems, you've primarily fixed like 70% of the problem. If you can fix fear of missing out and fear of losing, you fixed a major part of the trading psychology problem that most traders have. So how do you think that you get rid of those two fears? Fears of losing or fears of missing out on a trade? Backtesting. Man, it's amazing. Backtesting will definitely help fix the fear of missing out. Why would it help? Why would that help you get over the fear of missing out on a trade? Why do you think that would help you? Anybody? Learning the pair and how it moves. Yes. You're learning the pair. Really what you're doing is you're learning the pattern that pair produces, right? And how it produces a pattern. Basically, you're learning market maker behaviors for that pair. Is what you're doing. So you have to remember that your brain, its sole purpose is to keep you alive, right? The sole purpose of your brain is to keep you alive, but it also wants to stay comfortable, right? It never wants to go outside of certain realms, right? So that's why most humans in general, right, they have certain things that they do over and over and over and over again, right? They don't go outside of that, you know? You ever thought about the fact that if you go to sleep, if I go to sleep and I want to wake up super early tomorrow morning to go to the gym, and I set my alarm clock to get up at 5 o'clock in the morning or whatever. I go to sleep early, and 5 o'clock comes around, ring, 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 the thing goes off, right? You wake up, you look at your phone, you turn it off. Did you know that you literally have 5 seconds to take an action with your body of actually getting up before your brain starts to wake up and starts to ask you, hey bro, what are you doing up at 5 o'clock in the morning? Why are we up at 5 o'clock in the morning? Don't you want to go back to bed and get an extra hour of sleep? Do you really want to go to the gym today? Wouldn't it be better if we just do it tomorrow? Isn't tomorrow like the best thing ever? How many times do you say, I'll start it tomorrow? I can't be the only one that does that. Everything's always like, tomorrow. I'll start tomorrow. Tomorrow's a fresh new day, you know? Let's let's start things off right on a fresh new day, right? And then it's like, oh well, let's start fresh things off on a fresh new week. Or yeah, I'll start it next month on a fresh month. You know? That's what we do. We do that all the time. But your brain is literally meant to keep you comfortable and to just keep you alive. So anytime that there's a present danger of something going wrong, that's when you get that fear. Right? Fear of losing money, fear of missing out, fear of losing a trade. So backtesting allows you and basically teaches your brain that, hey, this type 1 pattern happens almost every day or whenever it happens, and yeah, it happens, so it's okay to take a trade. Or it's okay when I have these parameters, yeah, you can take that trade. There's no danger and you losing the money. You know what I mean? So the more that you do that, the more that you're teaching your brain over and over and over again that it's okay not to freak out over something. So that's why doing the homework and stuff that we do in the mentoring course is so important, because we're literally teaching the brain to understand, accept that this happens over and over and over again. It's okay for you to take the trade. The fear of loss, the fear of losing, a lot of times comes because most retail traders over leverage their account. They're over trading their account. They revenge trade when they take a loss. They don't have a system in place. And I mean, some people, they just don't like to lose, right? I don't like to lose. Nobody likes to lose. Who wants to lose? Nobody. but it's just the fact of what's going to happen. The question becomes, can you control the loss? Can you control a losing streak? And so that's why that risk management plan's in place. So you stop the losing, stop the bleeding, and start over. Another reason is impatience and waiting for the right setup. Impatience and waiting for the right setup. How many of you guys are on social media and you see people bragging about their trades? Stop me if you haven't heard that before, or stop me if you haven't seen it. Right? Every day. Every day. And it's like, man, they never lose. Right? They never lose. How is this possible? How is it possible that they don't take losses? Do you really think that? Do you really think that they don't take losses? Come on. Do you think that Warren Buffett never takes a loss? Think that George Soros ever took a loss? So don't worry. Don't worry about what other people are doing. Don't worry about how other people are trading. At the end of the day, they don't pay your bills. So it doesn't matter. I would not worry about what other people are doing. Imagine if you're worried about losing whatever, $300. Could you imagine what happened if you were to take a $2 billion hit? How would you feel if you think it's bad losing $300, $1,000? Imagine losing $2 billion of investors' money. This was the loss. This was a real loss that was taken by George Soros back in I think it was 98, back when they had the Russian debt crisis. And then I know he ended up losing another 700 million in '99 during the tech bubble. So imagine 2 years losing close to 3 billion. It's ridiculous. So impatience and waiting for the right setup. This is why I say 3 to 4 trades a week. You're not looking to trade every day. You're looking for the right trade. It's either there or it's not. If it's there, great. If it's not, great. It doesn't matter. The fear of a losing streak or a drawdown. We just talked about that. You have a fear of going into a losing streak or having drawdown on your account. If you have a fear of drawdown on your account, you're definitely over leveraging your account. Has anybody ever made the mistake of putting in the wrong lot size on their account when they took a trade? You did it last week. I remember I was trying out a strategy, and I put in $100 into a trading account, and I was doing pretty good because I was trading 0.01s, right? And on MetaTrader, you can switch from one account to another, but the lot sizes actually stay the same from account to account. So I went from my normal account back to the small $100 account, and the lot size stayed the same. It was a standard lot. And I put in a trade, and literally in 5 seconds, the whole thing was gone. The whole $100 account was gone in like 5 seconds. And I'm like, damn, that sucks. So it happens. The lesson from that is just don't trade from your phone like that. Like, don't just trade exclusively on your phone, in the sense of like, don't, just pay attention to what you're doing. And then lastly is the lack of discipline in following the rules in your plan. How many of you guys ever created a trading plan before? Give me a yes or a no if you've created a trading plan before. So if you plan on trading, you need to plan the trade, right? You need rules, something to follow. Because if you don't have any rules, you're just doing whatever. And if you're doing whatever, then anything is pretty much a possibility, So before you even think about trading, you need to write down, have a plan in place of how you're going to trade. Because without that, forget it. It's like trying to navigate a boat without having a GPS. It's like, how are you going to get somewhere? You're leaving, whatever, Florida, Port of Florida or whatever, or Port of Miami, and you're trying to get to the Bahamas or something. How the hell are you going to get there if you don't know where you're going? What happens to a boat if you don't got GPS? You're never going to get there. So you need a plan in place. And And then there's one more thing, it's consistently searching for the next big thing. And so what I mean by that is, how many of you have gotten a strategy from YouTube, whatever? You started trading, started winning, like, yes, I found the strategy. And then you take, I don't know, 3 or 4 losses. You're like, man, the strategy sucks. I got to find a new strategy. How many of you guys have done that? What's a good thing, Sam? If that's all you know. But nobody else has done that? And you end up going from strategy to strategy to strategy to strategy to strategy to strategy. And at the end, you have all this convoluted crap in your brain about how to trade. And you're literally trying to mash it together. Right? You're trying to put it all of these different 20 strategies that you went through in a year and trying to put them together to create one. So that's what happens. Yeah. So a lot of this stuff, when it comes to trading psychology, a lot of this stuff comes to really backtesting, having a plan, being patient, waiting for the right setup, having the rules in front of you. You already have, I showed you a risk management plan of what you can do. You know the strategy already because we just went over it. The only things that you have left to do is to literally have the fear of missing out, fear of losing. The only way you get that is through backtesting, right? That's the only way to get rid of that, is through backtesting. So that's what we're going to talk about next, is backtesting. This is the last topic. So some of you may ask, well, why do I have to backtest? Backtesting allows you to learn how the patterns and timing come together. It builds your confidence in yourself and your trading. It helps your brain to see the patterns as they are happening. It builds your behavior, or builds your understanding of the market maker behaviors. It gives you time to think about what's happening. When you're trying to do this live, you pretty much have 15 minutes, right? Before that candle ends or whatnots. When you're backtesting, you don't have that time pressure on you. You can really think about what's happening. And so the more that you do it, the faster you're able to process what's happening when you're backtesting. That completely transfers over to when you're looking at the live chart, because your brain is already processing everything that's going on at a way faster speed. because you've had practice of doing it over and over and over and over again. Also, the data that you collect is literally pure gold. It's pure gold. The data that you collect is what everybody wants for free. The data that you collect is what everybody wants for free. So if you take the time, to go back, let's say on pound USD, and you take the time to go back, let's say you're using TradingView or whatnots, and you go back, I believe you can go back up to 18 months. Let's say you go back 18 months and you start counting the total amount of let's say type 1 setups that happened for 18 months straight, right? Knowing how many type 1 setups that pair produces versus another pair is an advantage, because you know what pairs produce the most type 1s or type 2s or type 3s or whatever the setup it is that you're looking for. So the example that I used yesterday of pound NZD and pound USD, we had somebody do that, and we found that you're 3 times more likely to get a type 1 pattern, or GU produces 3 times more type 1s than GN does, than pound NZD does. So if you're a trader that likes to trade pound NZD and you like to trade type 1s, you're trading the wrong pair. You should be trading pound USD instead. But you wouldn't know that unless you went and got the data first to tell you. Does that make sense to you guys? Do you see where I'm going with this? So everybody wants the data, but they don't want to go back and get it. You guys should be seeing a white screen, is that correct? Okay. So, backtesting. What kind of stuff do you want to get when you're backtesting? So, spit out some things that you guys think you should be collecting. What kind of data should you be collecting when you're backtesting? Patterns, cycles, what else? Ward, what do you mean by M's and W's? Like, what is that? Candlestick patterns, yes. Got it. So if you're backtesting, right, there's a lot of different things that you can collect when you're backtesting. And so the problem is, how do you know what to collect, right? So if you're backtesting, let's say GU, and you go back 18 months or whatever, what kind of data should you be collecting? Well, the one thing that I want to know is how many type ones, how many patterns does it produce? So if I can go back 18 months, how many type ones? So we'll put like T1. How many type 2s? How many type 3s? How many type 4s? Right? That way you know what's the pattern that this pair specifically likes to produce over and over and over again. Because if I'm a type 3 trader or a type 3 trading setup, that's what I like, and GU just happens to produce the least amount of type 3s, guess what? I'm trading the wrong pair, right? So you need to find out how many types of each does that pair specifically do. That way you know what pair you should be trading based upon your actual setup that you like. Okay? So the next thing is, how many cycles does it do? So meaning like how many market maker cycles, accumulation cycles, or trending cycles. So what type of cycle does this specific pair like to create most? Okay. If you want to get really, really, really specific, let's use type 1s for example. For type 1s, you want to know what's the average time that the second leg of the M or W is produced. Think about if you knew the average time that GU produced the second leg of an M or W. Let's just say of a type 1. What would that do to your trading? Or better yet, how about which box on average is most likely to produce the second leg? So on average, which box on average? Is it the London box or is it the US session box? Meaning, what if you find out that most of the time on average, the second leg of an M or W is produced in the US session? What would you do at that point? Tell me in the chat. What would you do? Right, you look to trade New York, right? You would look to trade in the New York session. Same thing if you found out that on average most of the second leg M's or W's are produced in the London session. Yeah, or find another pair if you can't trade. Yes, exactly. Yes. there's no cycle that I can expect to see more than others on any specific pair, unless you go back and you count the actual cycles, right? If you go back and you start counting, you know, the amount of trending cycles, accumulation cycles, market maker cycles that pair produces, then you would know, hey, this pair likes to produce this cycle most often. So, example, I know that gold likes to produce trending cycles the most. I know that gold likes to produce multiple back to back cycles a lot. I know sometimes it could produce 3 trending cycles in a row, back to back to back. You know? So having that information, that only comes via backtesting and going back to the charts and getting the information, getting those data points. So take it a step further. What if you wanted to find out the average, like I was telling you, the average time of the second leg in the box, right? So what if you found out that, let's say, on average, the second leg of the MRW likes to be produced on London session, and let's say on average, the time that the second leg is produced is more than likely between 4 o'clock and 4:45. Knowing that information, what would that do to your trading? Right? So now, if you know that, I'm only getting my ass up at 4 o'clock in the morning, and I'm going right back to bed at 4:45. Right? So while everybody's up 4 hours or whatever, or God knows how long they've been up, you set your alarm clock for 4 o'clock in the morning, and you're done by 4:45. So you can get as specific as possible as you want. You can literally get as specific as possible as you want. The more specific that you get, just think about this, the more specific that you get, the more specific data that you have. At the same time, it means less trades. But the good thing is, the trades that you do take have a ridiculous amount of percentage of actually winning. Do you know what I mean? So when you backtest, when you're backtesting, what I would do is, let me switch over to the charts real quick again, so I could show you. Let's do new share. All right, you guys can see my chart screen, right? So let's just say that you like let's just say that you like to trade type 1 setups, right? And so let's say you want to trade, let's say you like type 1 setups and you know that GU produces the most type 1 setups out of all the other pairs. All right. So now with that information, you want to find out, okay, what do all of the type 1 setups all have in common? Because they all have to have something in common, right? Like I didn't make up the 5 or more candles between first and second leg out of thin air. You get what I'm saying? That didn't come out of thin air. Okay? Why 5 candles and not 4 candles? Think about that. Why not 4 candles? Why does it have to be 5? Where do you think I got that information from? So what you do is you go back as far back as you can, which again I think it's like 18 months or so on TradingView or whatnots. And let's just say that you replay this. Go to the 15-minute chart. All right, so let's say now that you start marking, you start looking at trade setups, and you're really interested in like type 1 setups, right? So let's say you're marking down possible type 1 setups that are here, that are actually like good tradable setups, right? So let's say you can use this tool here and literally start marking them. Start marking the type 1 setups. And so you're not even having to replay, you're just marking them down. So you go back as far as you can, right? And you start to now look at all of the type 1 setups that you have marked. And you literally ask yourself the question, okay, what makes this a good type 1 setup? What kind of confirmations are these type 1s, do these type 1 setups have, right? So again, how many candles is between the first and second leg? What does the TDI look like when that trade setup happened? Okay. On average, how many times did I get a railroad track star pattern or a cord of wood on the second leg so I can get in super early? You know? How many times did I have a pullback right after a big, engulfing candle or a big railroad track or something? So all these things matter because now you can build a list. You can build a list of different attributes that a type 1 setup has to have in order for you to take the trade. So you could have like a list of, 5 to 7 things, how many ever things you find. And so what are those things? You could say, hey, I noticed that most of these type 1s are pinning to an EMA or pinning to the 200 or whatever. Well, I found that most of these setups have the second leg railroad tracks. So now you start to create a list of 5 to 7 confirmations that a trade must have for you to take that trade. Just like when we were replaying the charts in London, we were going through, okay, what makes this trade a good trade? The pattern is there. Is it in the right timing? Do we have a second leg in the London or New York box? Does the TDI, is it in the right location on the TDI? Do I have a hook on the TDI, right? Did I get a cross here on the TDI? All these things are just basically used to help confirm the trade setup that you're looking for. And so you can build a list for just your type 1 setups, your type 3 setups, whatever setups you want to trade, solely based on the data that's available from that specific pair. Is this all making sense to you? Is it clicking? You know what the biggest problem with all this is? That it takes time to do it. That's the only drawdown. It takes time to do it. But how much easier are you making your life by actually doing it? Just think about how much easier your trading is going to be once you actually do it and you have a list. Your trading at that point now becomes very black and white, very yes and no. The things are either there where I can check them off or they're not. So think about what I talked earlier when we were doing the replays of the London session is like, what are you more likely to take a trade that has 3 confirmations or one that has 7? I think you're asking the wrong question. Not the least. What's the most? The further back that you can go, the more validated your data is, because the bigger the sample size. It's like you can do a small amount if you want to, but that's a really small pool of data. You know what I mean? It's almost like when they did the research on the vaccine and they started to do it, the early signs, the early data pools that they were getting were great, but the pools were so small because of the time of the length of the amount of people in the study. A study that you do for based on data captured for a 3-month period versus a data captured of a year to 2 years looks way different. And so the data pool that you get out of a 2-year, of collecting data for 2 years is going to be way more concrete than 3 months. Because what if within those 3 months you were just in a big, upward move or whatever on a daily chart? So I mean, even going back here to the data pool of of just the limits that you have on TradingView is 18 months. So I mean that in itself is like is a pretty good, is that's the least that I would do. Does anybody here use MT4? Nobody here uses MT4. They all use. You guys all use TradingView. Only to plug in your trades. Okay. I only ask because there's a software um, that you can get. Yeah, MT4, MT5. Yeah, there's a software that you can get that's called Soft for FX, and it's a back testing software. Um, it basically looks just like MT4, but the advantage of that is that you can go back 10 years. You have 10 years of data that you can go back to. Yeah, Ward. I mean, you don't have a choice, right? It is what it is. We can't control what happened in 2020. You have no. Yeah, yeah. I think the furthest back you can go, I think, is like September of 2019, if I'm not mistaken. But you can go back, for 10 years on that software. And also, when you're back testing, like when it's replaying the charts for you, like it's replaying like the actual like candles. You know what I mean? So like you're seeing like the candle go up, up, down, up, down, up, down, up, down, up, down. You know what I'm saying? It's not like on TradingView you get like boom a candle. So it makes it way more emotional, more real, way more realistic. It's I think it's $100 for a lifetime membership or a lifetime for the software itself. But it's a really good. I know a lot of the mentoring students that we have use it just because you can go back 10 years. But so is everybody clear on what kind of data you should be collecting for backtesting? Yeah, that's correct. So what I'm gonna do is I'm gonna email everyone a I'm gonna email everyone a backtesting journal. FXN. So here, I'll email it to you right now, so you guys would have it, or so you guys will have it. It's like an Excel spreadsheet. Let me see if I can open it real quick. Yeah, so let's share that. Desktop. All right, can you guys see this? Okay, so this is just a quick template so you can see what it looks like, right? It allows you to literally log all of your trades that you take when you're backtesting or even live, right? So you just put in the date, the day, the session. So if you click on it, you could change whatever session you want. If you're counting levels, you can put whatever level you want, hourly, what time you entered. So every aspect of the trade that you take, you can log. Entry, everything. So you have all the options that are available. And then at the very end, you can basically take a screenshot of what the trade looked like before and after. And so here's the empty one where you could start your own. You know what I mean? This is like an example of what it would look like once you have it filled in. But you go to template, and then you could fill this out. You can basically duplicate the sheet. You know, rename it so like GU or whatever. You know, and keep the template blank, obviously, so you can keep making duplicates of it. But then you could start to literally fill out and then take your screenshots of entry, paste the link here, and then paste the exit, what it looked like after it's done. Reason for exit, if you're exit early, what's the reason that you're exiting early? Wins, loss, I mean all this. Say whether you win or whether you lost, whether you win or lose it, your take profit point, what is it? I mean, so everything is literally right here for you. Divergence, true, I mean everything. Okay? So there's no, like, you don't have an excuse not to journal your trades. All right, so does this all make sense? You have any questions about this? So type in a no if you don't have any questions on the spreadsheet. All right. Let's see. The last thing here was. This All right, so last thing here is let's go over some of these examples that you guys sent in. Just some quick. So whoever sent this in, Ward, I think this was you. Here's some feedback for you on this. All right. So would everybody agree that this is a type 3? Just type in, let's do these quick. So just type in yes or no, yes or no. Would this be a good type 3 trade? Can you guys hear me or no? Okay, so is this a type 3 trade? Okay, so the answer would be, this would be a good type 3 trade, yes. This same thing, type 3 trade, yes. A failed type 3 trade, yes, this would be a failed type 3 trade. No trade, good. Type 3 or continuation trade, yes. Yeah, prices will sometimes pass the mid-range, Ward. So that's okay. This is still a good trade because it's bouncing off the 50 EMA. Okay. What's the second trade on this chart here? There's a type 3 trade on London. What's available in New York? A type 2, right? Or a reversal, whatever you want to call it. Yeah. Type 3 trade, would this be a good type 3 trade? Yes. No trade here, good. And let's see, this is bouncing off the back. Yeah, so this would be a continuation trade or, yeah, type 3 trade. Type 3 trade, good. Ward, what were you seeing here with this type 2? Because I don't get why you would take that. What was your thought process on this one? I wouldn't do to no pullback. Okay. So it's the fact that it's just a. Okay, gotcha. Sorry, but right, but you want a second leg though, right? You don't get a second leg here yet. You only get 1, 2, 3, 4, 5, but there's no real pushback for a second leg. So this would not even be a trade to consider, right? That's good. Yeah, so is this one, are you saying like this would be like a trade out of the edge? Is that what you're reading with this? Okay, gotcha. This coming back down would not be a trade that I would take because it's a one-legged trade all the way up at the top. So I wouldn't take this trade. I would want a second leg to produce up here before taking that. Let's see. I guess same thing here. Like there's only one leg here for this. So this wouldn't be a trade that I would take. If there's any trade that I would take here, it'd probably be a type 3 here. This is really messy. Okay, so trade out of the edge. Yep. That's an early first leg too. Oh my god. Look at the divergence on that. It's pretty big. So good one. I went through this one already. Type 2. Yeah, so this would not be a type 2 trade for me, Ward. The trade that is here is actually like a type 1 up here in London. So a first leg here, you get 1, 2, 3, 4, 5, and a railroad track on the second leg. That you can take down to the 200. Do you see that? Okay, yeah. So that would be the trade here. I would not be trying to buy this back. Let's see this one here. Good type 2 trade here. Good type 2. This one, trade out of the edge. I see it. I also see a type 3 here as well, but I take it this gave you a 2-to-1 risk reward ratio on this. That's what it looks like, at least. This wouldn't be a type 4 ward because type 4s happen in London, not New York. So this would not be a type 4. Yeah, no real trade here. It's not a type 4 trade, it's a continuation trade. So these that look like type 4s in US session, they're actually continuation trades. Because you're just continuing the move that happened in London. Okay. This would be a good trade if it was in the box. Yeah. Yeah, so this would have been a really good trade if it was in the box. I mean, the railroad track literally happened right at the edge of the box. So, multi-session type 1, yes, good. Type 1, but entry candle too big. Yeah, the entry candle is way too big on that. How big is that stop loss? I'm gonna assume like 25 pips or something like that, probably. No pullback either, so about 23. Yeah. You could take a continuation trade though here. If not, just stay away from it. Yeah, multi-session type 1 here. First leg here, second leg there. Yep, that's good. Type 1, that's good. Type 1, that's good. Yeah, so all these are good. Good job. All right, cool. Any questions? Any questions? About anything that we've covered? So type in no if you have no questions. Cool. All right, cool. So guys, it was a pleasure to have you throughout the 2 days. Thank you for being here, and I hope that you got a lot out of the last 2 days. I hope it was worth it. Cool. All right, so I'm going to be sending you guys another email probably later tonight or something with a survey. Okay? And you could be as honest as you want to. I don't care. I like feedback. Whether it's good or bad, it doesn't matter to me. If I do this again, I want to know how I could do it better. So, okay. So if you want to write something and stuff, you'll see the questions real quick, like 5 or 6 questions. That's it. All right. So I appreciate your feedback. Thank you guys so much. And as soon as I get these videos all edited and uploaded to the website and stuff, I'll be sending you guys out the login so you can replay this. Okay? You're welcome. All right, guys. Have a good one. Enjoy the what's left of your weekend, and have a good week. Good night.